Welcome to the What to Watch video. Every week I do a number of different videos. I do a video each day. I do a weekly video. I do an intermarket analysis video. And then I do a video that I call the deep dive video where I go through the charts. And some of those charts are unique just to the deep dive video. Other charts are charts that I may not be showing in the videos right now, but we still look at them because we can often get some insight. And that's why I call it the deep dive video, because we have to look a little deeper to see if we're being told anything. Then now the very last video that I record is the what to watch video, where I take those things that as of right now, I'm really focused on, and I have a positive list and a negative list, and I'll go through the list and then I'll show you the corresponding charts to show you what I'm looking at. Now, the idea behind this video is that it's supposed to be updated on an as needed basis. So if things really start to shift, if things on the positive side switch to the negative side, or if something new comes into the picture, I will do an update. But I just rolled this out in 2024. And so far, about as often as I get is once a week. So if you think that there should be an update to this video and you're not seeing one posted because I didn't think there was enough of a change, please go over and watch the daily videos, because all the videos that, or all the charts that I'm going to go over in this video, I'm covering every day in the daily videos. And this is being prepared for Monday, April 1st. So the first area that we look at are those things that are positive. Now, this scenario has developed kind of since last October, and then it was in doubt. And then as we got into 2024, it became more prevalent again, and now it's being backed up more by what the Fed's actually saying. The markets are anticipating that rate cuts will be slow. Now, that's the scenario that we're going with right now. This could change. The idea behind this is when the economy is still humming along, doing pretty good, and maybe interest rates are too high, the Fed can lower those, and the market really likes that. That's if we stay in this current environment. But something can happen. 9/11, a great financial crisis, the lockdowns like we saw. Something can come into the picture at any time to change this scenario. We don't know if that's even going to happen or what that's even going to be. We can only go with what we're seeing right now. We can predict all kinds of crazy things, but we don't know if it's actually going to play out that way. So we can only go with the information that we have in hand. On Friday, Chairperson Powell did give a speech, and it pretty much reiterated this idea that, okay, the PCE report, which also came out on Friday, that came in as expected, not really freaking out the markets. At least we'll find that out Sunday afternoon or evening when the futures start to trade again, and then how the market reacts on Monday, because the market was closed on Friday for Good Friday. But that came in as expected, and then Chairperson Powell's speech later on in the day kind of confirmed that, hey, we're in a pretty good place right now as far as the economy is concerned. Now, there's stock market economy and there's real person economy, and the two may be really disconnected from each other. Things might be looking better from a stock market perspective, but there's a lot of people that are really struggling with current economic conditions. All right, sentiment continues to be positive, and it's not extreme positive right now. We're coming in under 75, and I'll show you that chart. When we get above 75, that means that maybe we're getting a little too extreme positive, and that's when we entertain the idea of using it as a contrarian indicator. Now, for most of 2024 and even back into 2023, we've been pretty positive, and we've stayed up in that area, and we can continue to stay up in that area. But when we do get excessive, we want to at least be open to the idea of, okay, maybe the market's a little too happy right now, and we could see some kind of a pullback. If a pullback starts to develop, we'll see, is that going to morph into more of an actual decline? And then how intense is that decline going to be? Then the all-time high was set again for the S&P 500, and we have a lot of the major indexes coming off of setting recent all-time highs. When we take all the technicals together and we look at the S&P 500, you can take this in a positive way, saying that, okay, our indicators are quite positive, maybe a little too positive, and then you can switch over to the negative side and say, maybe we're overbought and due for a pullback. But we've been in this condition for quite a while now, and even when we see down days, they're not that big of down days. And then the market finds a reason to go back up, and then we become extreme positive or overbought again. But we want to respect that at the same time. There's two sides to watch at the same time here, that we're showing good momentum and that maybe we're getting a little excessive. And at some point, folks may come in and start to take some profits, and that could lead to a more substantial pullback, which could turn into a decline. I'm kind of putting seasonality off to the side for right now. We just didn't follow it in the month of March. Now that could change at any time, but I'm not really focusing on that as much, at least yet. Now we could come back and really start to follow historical seasonal patterns, but we certainly didn't do that for the month of March. The S&P is still above long-term resistance, and we're up above 5,200 now, where this long-term resistance is at the 5110 to 5111 level, and we're still above that. And the longer we stay above that, I'm still calling it resistance, but if we do see some weakness, this may end up acting as support. The longer we're above it, the more chance that has of actually turning into support. The S&P is in an uptrend, especially on a short-term basis, and it's been in an uptrend, and it still continues to look quite positive. We're above the 20-period moving averages. If we start to see a decline, the 20-period moving averages, and I know there's folks that use a 19 and a 21 and a 23. I just settled on the 20s because they're not all that different from each other. But that's going to be the first line of support. Initially, it was above these upward sloping trend lines. Well, we're still below them to a degree. And now if we do start to fall, it will be the 20-period moving averages that could come into play. If we drop below that and the other indexes, because there was a time a few weeks back when we didn't get down to the 20-period moving average on the S&P, but we did for the Nasdaq 100, and we bounced up off of that. So it doesn't mean that we're just watching the S&P itself, but if we do fall below that, then we'll be keeping an eye on the 50-period moving averages. And then we have some 20, 50, 100, and 200-period moving average studies. These are stocks inside of the S&P, and how are they doing based on the various moving averages. For right now, they're positive and improving. Parabolic SAR, which is one of the more important intermediate term indicators that I use, that still remains positive. And we're looking at both the S&P 500, that's the index that I focus on, and then on a broader market level, we look at the NYSE and the McClellan oscillator, which is a more short to intermediate term momentum oscillator. Those continue to be positive for both indexes. And when those are positive, then they go over to a longer term index called the summation index, and that's continuing to be positive as well, or those are positive. The S&P and the NYSE bullish percent indexes are positive. Now, one thing that you'll get to on the negative part of this video is we're seeing some weakness in the Nasdaq 100 bullish percent index. It hasn't turned negative yet, but it has been declining. The S&P and NYSE bullish percent indexes are looking quite positive right now. And then we're seeing a real improvement, not only in the S&P, but also in the NYSE with the advanced decline lines. They are positive, and we're seeing volume actually leading things higher. And when we see volume ahead of price, that tends to be positive. And then when we look at the Nasdaq 100, the trends are still positive. Even though it didn't have a really good week this last week, it was actually down. We're still above the 20-period moving average. And also with the Nasdaq 100, we're above more short-term resistance. And then we look at a very long-term chart, and we're still above that long-term resistance as well. The ratios that we look at continue to hold up for right now. And so we go into our different charts. Now, this is put out by NDR, showing some research that they did, that when the Fed is able to cut rates at a slower pace and responding to more of economically what's happening in the U.S., instead of some catastrophic event, that tends to be more positive for stocks. If it does have to react to something and it has to cut rates because the economy could be in danger of falling off a cliff, that tends to be more negative. Now, we don't know if this is going to change, but for right now, it looks like we're going with the slow cycles, and that's longer term positive. Here's the Fear and Greed Index put out by CNN Money, where we're below the 75 level. When we do get above it, that's when we start to look extreme positive, and we can even go above 75 for a while. If we get up above 75, but yet keep going up, that's good. But if we start to roll over, then that's when we start to take notice of this. While this sentiment gauge continues to go up, we ride with it. It's when it starts to get extreme. That's when we look at using this as a contrarian indicator. We just notice this and then start to look for other charts to say, okay, is weakness coming into the market to confirm what we're seeing on a sentiment basis? And this is a weekly chart of the S&P 500, and these are pivot points where we're above this R1 level. We came right up to it, bounced back down, came back up, bounced down. Now we've been able to extend price above this longer-term resistance level. Just to show you why this is important, we came up to one of these resistance levels back at the end of 2021, and then we went into 2022, and that was a really rough year. We finally hit bottom in October of 2022, started to chop our way back up. We hit another one of these pivot points in July or August of 2023, and then we spent the next few months going down into the latter part of October. Now we've been bouncing up out of that. Now, the longer we can stay above this R1 level, if we do see some weakness, the more that this may end up acting as support. Right now, it's kind of right on the fence, whether this would be support or if we would just slice back through this. Here is a short-term chart where we were going up really fast. And that's when I drew this red trend line. Well, we started to drop down below that. And then I drew a blue trend line with these other lows. We're below this a little bit, but we're coming right to the underside of this. But overall, this is still looking positive in the short term. Now, the market can't help but struggle with this because this is an upward sloping trend line and it's continuing to go off or go up off into the future. And so we're going to have to see some real powerful price movement to get back above this blue line, let alone the red line. Here's the 20-period moving average study. And I plot both a simple moving average where every period is treated the same and an exponential moving average where it's more weighted towards more current prices. We're above both lines right now. If we start to fall, we'll be watching this level to see if it offers support. Then we look at those stocks inside of the S&P 500 that are above their 20-period moving averages, and we're getting a really high reading. This is showing some improvement. However, longer term, we're still seeing a negative divergence here. The longer it takes, or I should say, the longer we get away from this really high reading that we saw at the end of November and into December, the more irrelevant that will become. So, but we just want to be aware of that. If this keeps going up, that would pretty much negate this negative divergence that we're seeing. Then we look at those stocks that are above their 50-period moving average, also seeing a longer-term negative divergence, but this chart is improving and we're not getting really extreme with this. This is more intermediate term. Then we switch over to the long intermediate term to short-term, long-term. How's that for craziness? This is the 100-period moving average study, and we've been hanging out along these levels pretty much since the first part of December. This is suggesting good momentum. Now, at some point, if we start to drop below this, we'll take note of that. But for right now, we've just been riding this wave. Then we look at the 200-period moving averages, and we're getting a really high reading here. That could suggest good momentum, or if we keep going up and then drop back down, that means that 80% of stocks in the S&P 500 are above their 200-day moving average, and that's usually considered to be excessive. And at some point, folks are going to want to come in and take some profits. So we'll keep watching this. And this is the parabolic SAR. This is, in my opinion, a very important intermediate term indicator. When the dots are underneath, we're positive. If we get to the point where prices start to decline and the dots shift and they're on top, that would turn this more negative. Let me look at the McClellan oscillator. This is more short to intermediate term, and this is a momentum oscillator. When we're above zero and going up, that's positive. We're also seeing a longer-term negative divergence. When the McClellan oscillator is positive, that means the summation index is positive, and we're going up based on price. But if you notice here, we're also going up based on volume. Now, the top indicator and the bottom indicator are two completely different indicators. I just plot them on the same chart. We're seeing volume actually looking stronger right now than price, and that could end up being positive. Then we look at a broader measure, looking at the NYSE McClellan oscillator. We're above zero and advancing, but we also have a longer-term negative divergence. The further away we get from this, the more irrelevant that would become. So when the McClellan oscillator is positive, the summation index for the NYSE based on price is going up, and we're also going up with a little bit more strength based on volume. Then here's the bullish percent index, and I like this because this is not moving average based. This measures the point and figure buy or sell signals inside of the S&P 500. When we get above 70, yeah, we're looking extreme, but we're continuing to go up for right now. If we top out and start to come down, that would be warning sign number 1. If we drop below 70, that will be warning sign number 2 and is actually a sell signal. And if we go all the way down and drop below 50, that's actually when it's turning more negative. But for the time being, we're maintaining good momentum, and this is continuing to go up. Then to get a broader market measure, we look at the NYSE bullish percent index. This is continuing to go up and not above 70 right now. This is showing a little bit more broad market participation. Then we look at a cumulative measure of the NYSE advanced decline line based on price, and this is really going up. And it's not necessarily breaking out above previous levels, but the fact that this is going up also is showing broad market participation. On the bottom, we have more of a regular advanced decline line, and this is looking a lot more positive. This is where we have another advanced decline line for the NYSE calculated a slightly different way, and this is actually breaking out above previous highs set back in 2021. So the broad market is starting to look more positive. And then we look at a cumulative measure based on price for the S&P, and that's breaking out to all-time highs. And we also do a cumulative measure based on volume for the S&P, and this is breaking out to all-time highs. And you see how this is going up with more strength than based on price. That could end up being positive. When we look at the QQQs, which is the ETF for the Nasdaq 100, we're still above the 20-period moving average. The red line is a 50-period moving average, and the lower blue line here is the 200-period moving average. So in a trend, when we look at the trend for the Nasdaq 100 or the QQQs, we're still in a solid uptrend. This is a weekly chart of the Nasdaq 100 with a trend line going all the way back to 2009, and we're still above this. So the long-term trend is still positive. Then we do a ratio between the Nasdaq 100, which is more growth, and the Dow, which is more value. And we came up to a really high reading back in 2000. This was the dot-com boom. And then everything fell apart, and this was the dot-com bust. It took us many, 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 many years to get back up to this same ratio level again. This, unfortunately, was right at the end of 2021. And then we went into 2022, which was a very difficult year if you're a trend-based trader or if you're always long the market. And then we finally bottomed, and we're coming back up to this ratio again. We went a little bit above it. Now we're just a little bit below it. This is long-term, and this is what the perma bears are using as reasoning for believing that the market's going to fall apart. But they've been pointing this out for quite a while, a number of months now. We'll just watch this unfold. This can take a long time to actually develop. There's a similar type of study where we look at the Nasdaq 100 or QQQs and the small caps. Now, the Nasdaq 100 was down on the week and small caps were up. So we saw this ratio come down just a little bit, but we're still really close to these high levels. If this continues to go down, that would turn things more negative. If it turns and goes back up, that would turn things more positive. Now we look at the negative side, where we have a thing called the skew index. I cover a thing called the VIX, which measures fear. When the VIX is high, it's time to buy because we've been going down. When the VIX is low, it's time to go because we've been going up. Well, there's a similar type of index called the skew index. The VIX uses at-the-money options to be calculated. The skew index looks at out-of-the-money options, and this is flashing a signal. Now, we don't know. I could have put this on the positive side. This could also be negative because we don't really know if this is making us scared or is going to confirm that we're going to go higher from here. I'll show you that chart. And then the point and figure chart, it's positive, but it might be looking a little too positive. And then accumulation distribution, this is weakening. Now, we are coming off of a holiday week where we didn't trade on Friday. A lot of the smart money may have taken some time off. Every day of the week was below average with volume. And so we can't help but see this indicator start to trail off because it uses volume in its calculation. But this is supposed to be a smart money indicator, and it's showing some weakness right now. And then kind of that goes hand in hand with that is a thing called the Chaikin money flow. It's actually turning negative. It's dropped below 0 and has been declining for a while. The vortex, it's still positive for right now, but it's also drifting lower and showing some weakness. And then we look at some intraday charts based on 10-minute intraday bars, and the growth to value ratios are now declining. Well, usually in the environment that we've been in for most of 2023 and the early part of 2024, that would cause some issues. Are we seeing a shift in the overall environment of the market where it's okay for value to do well and growth doesn't always have to outperform? We don't know the answer to that yet. We want to keep an eye on this and then try to put this together as it's happening. And then we also look at end of day growth to value ratios. They are declining for right now. And then discretionary, which typically does better in the environment back in 2023, it's been underperforming now. Even though both discretionary and staples are in uptrends, we would like to see discretionary doing better unless we're seeing a shift in the overall economic climate. Then the Nasdaq 100 bullish percent index is still positive, but it has been declining. Remember the S&P and the NYSE, they're going up. The Nasdaq 100 bullish percent index is declining, but it's still positive. And then this is longer term, and we've been keeping an eye on this for quite a while. The transports are negatively diverging from both the Dow and the S&P 500. And we're seeing a little bit of an improvement. They had a good couple of days this past week, not enough to really shift things over to positive, but we want to see if that's going to continue. And then small caps also had a good week. They were the strongest index, up 2.5% this past week, but they still have a long ways to go to show more improvement. This is the last main index to hit an all-time high, and it still has a ways to go to do that. And then the US dollar, we've just seen a recent golden cross here. That's meaning it's changing from a downtrend into an uptrend, and a stronger dollar can put pressure on stocks. Here's the skew index. When we get up into this red area, that means that the market is expecting some kind of a big move. And I tried to mark here when we hit this spike and then started to come down. And sometimes this marked a top, sometimes it was a bottom, sometimes just a continuation. The market's concerned about something, but according to this chart, we're not exactly sure what. Then we look at the point and figure chart, and this does not take time into account. It can take an hour for a new X to be drawn or a whole year. The market has to move a certain amount before a new X is drawn. Well, we're seeing a really high move up here with the X's, and that's positive. But if you look up here at the top, that's red. That's a warning. It's coming up with a long, tall up, and that was generated way back on March 7th. So we've been seeing this for a while. Just to let you know, we're not seeing this signal on the weekly chart. We're only getting this on the weekly or the daily point and figure chart right now. This is positive, but maybe a little too positive, and that's what we just want to keep in mind. Here's the accumulation distribution. We're going back to the beginning of November. We were above the advancing moving average. Well, now we've kind of dropped below this. Was that because it was a holiday week and a lot of the smart money took some time off? Are they going to come back and start buying and push this indicator back up? Or is this warning us that, okay, maybe some weakness could be starting to come in? We're also seeing that with the Chaikin money flow, another volume-based smart money indicator. We've been going up with the S&P. We've been declining with the Chaikin money flow to the point where we've now actually turned negative. And we look at the vortex. It's positive because the grain line's on top. But you see how it's drifting lower here? Even though the S&P has been going up, a little bit of a concern there. And then here's an intraday chart. In a more solid environment like we were seeing earlier on, when the blue line's above the red line, that's positive. Well, now we're seeing the red line above the blue line. Does that mean we're seeing some weakness coming in, or are we seeing a shift in the economic climate? Here's another look. S&P growth to value on a 10-minute intraday chart. We've been chopping sideways since the early part of March. Now we're coming down and could potentially be breaking below this range that we've been in, which we typically have viewed this as negative when this is going down. But if we're seeing a real shift and value stocks can still do well and growth stocks also doing well, we might end up seeing this for a while. Or if this continues to fall and then we see weakness and we see growth really pulling back, we'll know that the overall situation really hasn't changed. And we break this down on an end of day basis. We look at small cap growth to value where we broke out and now we're starting to fall back. We also look at mid caps growth to value, broke out, starting to fall back. S&P growth to value ratio, broke out, starting to fall back. We don't know if this is negative. In the interest rate environment that we had been in and with the Fed being more hawkish, this would cause us some concern. But now that the Fed is shifting, we don't know if this is going to be a concern or not. In fact, you can see where we went down from really the last part of October into November, even to the end of 2024, this was going down while the S&P was going up. So it doesn't mean that the market's going to go down. It just means, okay, what's happening in the market to change the climate? Then we look at discretionary, which is in an uptrend, and staples, which are also in an uptrend. And typically we would want to see discretionary outperforming staples. They are in an uptrend, but they're not really breaking out. Then this is the Nasdaq 100 bullish percent index, where it's still above 50. So it's positive, but it has been declining. The Nasdaq 100 did not have a good week this past week. And we're looking longer term. Here's Dow theory, where we're setting recent all-time highs with the Dow. We're doing better, and this is bouncing up a little bit with the transports, but we're seeing a negative divergence here. And this is a Dow theory non-confirmation. If we are shifting to where interest rates are going to start to go down, maybe the transports will do a little bit better, continue to go up, surpass the previous all-time high, and eventually confirm the Dow setting all-time highs. It hasn't happened yet, but we're going to watch to see if that ends up happening. And utilities have been in a downtrend, but they saw a little bit of love later on in the week last week. This is just looking at the transports by themselves. Not really a breakout yet, not even above where we were at earlier in 2024. This is the high set in 2023. This is the all-time high set back in 2021. And then we look at a ratio between the transports and the S&P, declining overall, but bouncing up a little bit. But we want to see more follow through with this before we actually form a conclusion about this. There's the small caps. Finally, we're able to break out on a closing basis and intraday basis above where we were at the end of December. But we're still pretty much range bound. However, the fact that we're breaking out is positive. If you look at the blue line and the red line, we are in an uptrend. Then we look at the Russell 2000. Now, there's two small cap indexes that I follow. There's an index put out by S&P, and there's also the Russell 2000 small cap index. And we're looking positive here too. With the longer term uptrend, we are breaking out, even though this is kind of a scary bar to open, go up, and then close pretty much at the low for the day. But when you look at the RSI, we're above 50 and going up, and we're starting to turn more positive on a momentum basis. Is this going to show some improvement here? This is kind of the last area, and this is what people are wondering. Well, we've got all these other indexes hitting all-time highs. Are small caps going to start participating? If we're shifting over to a declining interest rate environment, that could be what we're seeing, but we're not seeing an awful lot of confirmation yet. As denoted by this next chart, we look at a ratio between the small caps and the S&P. It's still underperforming. It's bouncing back up, but we want to see this continue to go up on a consistent basis to the point where we see the blue line cross above the red line. Then we look at the dollar, where it's above both of the moving averages here, and we are seeing a golden cross. This could put some pressure on stocks. Stock market likes a weaker dollar. And with this going up, that might cause some problems. So thank you. I really hope you found this helpful. Please feel free to check out the other videos that I post. I'm recording this on Easter Sunday. I want to wish everybody a very happy Easter, and I will talk to you in the next video.